Good day, and thank you very much for joining us. My name is Dan Farley. I'm the Chief Investment Officer of the Investment Solutions Group at State Street Global Advisors. And today I'd like to spend some time talking about how we see the market environment evolving, some challenges we think that investors need to be taking into consideration, and talk a little bit about our multi-asset class builder fund, which we think is a good solve for many of those investor challenges. So if we think about the evolving environment that we're in and the world that we've come from, investors have really benefited from very strong returns over the course of the last decade. Stocks have been great, bonds have done well, and investors have reaped the rewards of that as they've managed their portfolios. Now, however, as we think about going forward, though, we think that evolving market environment probably presents some opportunities, but as well as some challenges. And from our perspective, investors are looking for multifaceted strategies that'll help them evolve in this environment. And the State Street Multi-Asset Builder Fund is one that we've designed both to take advantage of the growth opportunities as well as be very mindful of the risks and manage them accordingly. So let's talk about some of the evolving market environment. So as we think about the challenges that are facing investors as we look forward, one of the main ones is the declining expectations of returns across the capital market. From equities to fixed income, the expectations that we have, and many investors have come down across the board. Public equities, private equities, fixed income. In fact, if you look at our expectations today relative to a decade ago, you see that we expect equities to return mid to upper single digits, fixed income lower single digits, and in some cases even negative. And the challenge for investors is that when you put that together and combine it into a total portfolio expectation, you see returns that we would have seen or expected to be up closer to 9% a decade ago are now below 6%. That becomes a challenge for investors to think about how do they drive return, how do they drive growth to meet their overall goals. The second issue that we see out there has been around the role of static portfolios as it relates to downturns. Now, clearly, all investors are worried about drawdown, the impact it has on their portfolios, and the experience that they take as they go through there. And what we see is that historically, the traditional static portfolio, a 70-30 stock to bond mix, has not provided as much diversification as investors would have wanted in those drawdown periods. It provided some, but clearly, as we see, whether it be the global financial crisis, the tech bubble, et cetera, there's been pretty significant drawdowns in the portfolios. Now, if we take it more recently, over the course of the last several years, we've also seen some drawdown situations, but I'd argue that these have been pretty shallow and they've been fairly short-lived. And so investors thinking about the need for diversification, the need for drawdown protection has probably been lost because of the experience we've had over the last couple of years. The other portion of this that we need to consider is this focus around the outcome. What are people looking for? And how can we be a bit more dynamic in the portfolio to help add upon or improve upon what we see in the static portfolio mixes? Now, one of the things that I think is quite obvious, but sometimes lost on people, is the fact that when you look at different types of asset classes, they tend to do very well in certain environments and not well in others. And so when we think about the types of things that we hold in a portfolio to drive growth, like equities, they're the things that are our catalyst to hit the return targets that we need, but they're also the things that are going to catalyze the risk that we have in the portfolio. And so as we think about the outcomes and we think about managing those downturn environments, we think it's critically important to take a more evolved approach, one that's looking at being more dynamic in the portfolio in a way that allows us to be in growth assets at the right time and away from them at a time that will be more negative for the portfolio mix. I think the other challenge that investors are going to have as we look to move forward here is that many of the traditional measures that they used for diversification are probably not going to work as well as they have historically. And specifically, I'm thinking about now the role that government bonds have played as a diversifier in portfolio mixes. And there's a reason why people have done this historically. It's been a good diversifier, it's worked. But I think the challenge is that we look to move forward, that given the level of rates that we're at right now, the dry powder of government bonds is probably going to be limited as we look to move forward. So for example, if we look at a traditional 60-40 portfolio and needed to understand where would bonds need to move to offset a 10% decline in equities, what we see across the board is some pretty dramatic shifts in the level of yields that you would see off of your bond portfolio. So for example, in the US right now, long-term bonds are yielding about 1.8%. They would need to drop to almost zero in order to offset that 10% increase. If we saw the Australian market or the UK market, we'd have low returning yields that would have to go negative, and they'd need to go further negative in the Eurozone and Japan. So that's not to say that government bonds can't continue to provide some diversification. The point, however, is being that the level of diversification, the amount of drawdown protection that we get off of this part of the portfolio is probably going to be limited as we go forward. And investors need to think about that as they consider how they're building their overall portfolio mix. So as part of this challenging environment, the thing that we've tried to do is build a solution that will help investors manage through this need for growth and this need for diversification. And that's our multi-asset builder fund. The strategy is managed with a CPI plus 5 objective, so very focused on the outcome as opposed to a benchmark relative or market-based return type situation. This strategy has been designed for Australian investors, leveraging the global insights of our investment solutions group, but is very much focused on how do we receive the outcome that we're designed to get. Now we do that for a number of different ways. First and foremost, the strategy is managed very dynamically from an asset allocation perspective to drive portfolio construction in a way that we're targeted on growth assets at the right time and defensive assets at the right time. But we've also seen that the strategy is very well diversified across different sources of return. So things in the growth category will include Australian equities or global equities, emerging markets or REITs, high yield bonds, and the like, with the idea to make sure that we have many levers to pull to help meet the return objective that we have. The portfolio, from an outcomes perspective, has looked a lot like traditional alternative strategies that are out in the marketplace. However, the fact that it's long only, very transparent, has been an area that investors have preferred, and we found that people are using it for a variety of different ways in their portfolio. The fund offers daily liquidity, and as such is very focused on risk management. And at 58 basis points for expense ratio, we feel very highly competitive in the marketplace. When we look at the outcome and performance of the portfolio, we've been very pleased with what we've been able to deliver for our investors. Since inception in 2014, the fund has returned gross of fees 6.5%, net of fees 5.7%, very much in line with the target objective that we have. And while I'm pleased about the performance numbers that we've been able to put up, I'm equally pleased with the level of volatility or risk that we've been able to see in the portfolio as well. Since inception, the fund has run at about 5.5% in volatility, and that's true across all the different time periods that you look at. And so we've had a consistency of return that we've been able to play across the board, taking out some of the highs and the lows and providing a more stable return stream for our investors. Now, one of the things I think is interesting when you look at this strategy is the versatile nature of it. And I mentioned this before. And I think what we've seen is investors using the fund in a variety of different ways. In some cases, folks have used it as a core holding in the portfolio, looking for a stability of return and owning other satellite strategies around it to help complement for specific client objectives. We've also seen people using it as a tactical sleeve in their overall portfolio. Because the fund is very dynamic, making significant shifts in asset allocation, this can be a complementary return stream to other strategies that might be part of a broader portfolio mix. And lastly, because it has a real return and absolute return nature to it, we are seeing people use it as part of their alternatives bucket, as a complement to either other alternative strategies or as a broader diversifier in the overall portfolio. So regardless of whether it's been core or tactical or part of the alternatives piece, the stability of return and the stability of volatility has been an area that we think has served investors well as we've gone forward. So to sum up, if we think about the strategy for Builder, it drives a number of different things. It's objective-based with an outcome orientation as opposed to a market-based orientation. It's dynamically managed in order to be able to navigate the evolving marketplace that we expect to see going forward. And it's one that is built for Australian investors and identified as a way that they can use it as a tool in this evolving marketplace as we go forward. So thanks so much for your time today and your interest in Builder. If you're looking for more information, please click the links below to either go to the website or reach out to some of our team, and we'll get back to you with that information as soon as we can. Thanks so much for your time today.